S Naren joins us, Executive Director and CIO with ICICI Prudential AMC. Naren, I was hoping that you would join us a month before when there was fear on the street. You're joining us when things are looking balanced. There is no fear and there is no greed. We missed you when there was fear on the street in March beginning.
Actually, what it was our view for the year has been asset allocation and volatility. So maybe that's why we decided to come back and talk to ET now when again we can recommend asset allocation and volatility. Maybe that's the reason. I think we are in a very difficult year for investors. I mean, we've never seen the Fed talk so hawkish, and it's unbelievable that the equity markets have reacted so positively to the Fed talking so hawkish, and it's only the debt markets which have reacted negatively to the Fed talking hawkish. So it's a very interesting 12 to 18 months ahead. And I think we have to watch the markets over the next 12 to 18 months. And it's going to be a very interesting period for investors because for a 18-month period, making money by being bull was too easy. And I think the next 12 to 18 months is going to be much more choppy and much more difficult. And I think that is going to be the situation at this point of time.
Naren, you are a top-down investor, which is just for the benefit of our viewers. Naren looks at the big picture and then he makes a case for investment. Now the big picture, Naren, needs no introduction. High inflation, Fed tightening, impact of war. It is not just restricted to oil and gas now, it is restricted to wheat and pulses. So why is that markets are not panicking? I mean, there has to be a reason why markets are not panicking.
I think basically one is we have got now a lot of investors who believe in equities as an asset class. And in a way, it becomes like 90s, where people believed in equities as an asset class. So, and you had a long extended period of time when equities have never delivered big negative returns. So consequently, when I tell people that I come from 90s also, when equities have delivered big negative returns, people say, no, equities will never deliver big negative returns. So I have to tell people equities is a riskier asset class than what most of you people think. So no one believes me at this point of time. So that's why markets tend to recover and there is massive retail interest at this point of time. And that massive retail interest in India has ensured that even a lakh of crores of FIIs selling has been very well absorbed by the local investors. And that is, I think, the reason why all the negative news that we saw got completely absorbed. And that has been a surprise for me. But having said that, I would say that I'm worried that whether investors recognize the risks of equity. And that's the reason we've been recommending asset allocation over a period of time. And because I think asset allocation is the best way to recognize the risk of equity so that you don't miss debt, you don't miss gold, you don't miss other asset classes rather than thinking that equity is the only asset class for everyone. And that's the way we think. But I don't think every investor thinks the way we at ICICI Prudential think.
Okay. Naren, so let's talk about asset allocation. How does one invest in this environment when we know interest rates are headed higher?
Actually, it's pretty easy. Actually, there are, thanks to the work done by SEBI and all the work done by all the mutual funds, we have interesting products like the floating rate product. So if interest rates were to go up, floating rate funds are the ones which will benefit the most. So you do have products which will benefit when interest rates go up. So if interest rates were to go up, look at floating rate category, and that is how we look at it. So it's not as if you're going to have only funds which will benefit when interest rates go up. Debt is not an interesting category. You can actually invest in floating rate category and benefit when interest rates go up. So that's easy way to invest in debt. So if you look at asset allocation the other way, we are big beneficiaries out of volatility. And if you look at a category like asset allocator fund of fund, which invests in equity, debt, and gold, And what happens in that kind of category is that you invest, sometimes gold goes up, sometimes as equity goes up, sometimes debt is only a balancing number. And what happens is with this kind of a category, you gain a lot out of the volatility which you see on a day-to-day basis. And I think the next 3 years is going to see a huge amount of volatility, and that is what we did. And so I believe that these kind of frameworks actually play a lot of benefit over the next 3 years. And one of the things which I've been very happy with the 18 years that we have spent in ICICI Prudential is, unlike 2008, where when equity markets came down, you felt very bad that we were too dependent on equities. Today we are no longer dependent on equities alone. We have a wide variety of products, starting with overnight and liquid and floating rate, and you've got so many asset allocation products that we no longer have to only think that if equity market goes down, the world is over. That's not the case we are in at this point of time. And that, I think, has been the good work done by SEBI, the good work done by mutual fund in launching many interesting products for the benefit of investors.
You're talking about interesting products, Naren. That brings me to your NFO. Tell us a little bit more about it.
We were looking at, what else can be done, when market is volatile. And we felt that other than asset allocation, one of the things which always works is you pick a theme which has done badly. So in the 2017-18 period, one of the themes which we looked at was the theme of commodities, because commodities had done badly for a long period of time. We had looked at pharma at that point of time because pharma had done badly for a long period of time. So we are always on the lookout for themes which have done badly to launch in bull markets. So now we found that housing as a theme has done badly for a long period of time, considering that our housing cycle all the way from 2013 to 20 had done badly. So we said that we should look at a theme like housing for investment at this point of time and launch a new fund offer on that. Because if you launch a new fund offer of a theme which has done badly, actually the long-term outlook from that point of time looks good. So, when we launched the commodities theme, people used to ask us, how can you launch a commodities NFO? How can it do well? But today we are at the reverse end, where we tell people you have to be more careful in commodities because every metal stock is at all-time high. And therefore, the risks on commodity fund is today possibly higher than what it was when we did the NFO. And now we have to do the reverse at this point of time. But where in housing, the theme hasn't done badly. So we're very comfortable launching a new fund offer. So our entire approach is look for a theme which is done badly and then see whether there is a good opportunity for the future and think of launching an NFO. That's why we have launched the Housing Opportunities NFO. And the advantage also with that theme is it gets to invest in a number of sectors like banking, cement, housing finance, and power, which have also done badly over many years. So it gives you an opportunity to look at all those sectors for the future. And we think that, along with asset allocation, looking at themes which have done badly is a good way to invest for the future.
Since you have that contra approach, Naren, I also wanted to talk about what's going on with the FMCG space right now. Management and company after company is indicating that they are under severe inflationary pressure because of, escalating commodity and input prices. Their margins are going to weigh heavy. And considering this is a problem that we saw even before the geopolitical crisis between Ukraine and Russia, this is not a recent devil in that sense, inflation that is. They only have that much elbow room to even up prices and pass it on to consumers. Is that a space also that one should look at or still avoid because, it's somewhat like dealing with an unknown. You don't know the gravitas of inflation yet.
In this channel, for the past 6 years, Nikunj has asked me this question and I've said we've been underweight. We continue to be underweight. But I think for the first time, we can tell people maybe people should consider a systematic investment plan or a systematic transfer plan in categories like FMCG or consumption kind of sectors at this point of time. Is it yet the time to do big lump sum investment at this point of time? Maybe the answer is no, only because of valuations. But otherwise, I would say at least the time has come to consider a systematic investment plan or a systematic transfer plan in these kind of sectors. And that is the change, I would say. When is the bottom? That is the question. I would say the outlook has certainly deteriorated. So that's why the SIP and STP has the sector bottomed out. That's a question we are having internal debates on a continuing basis. But clearly, it started to look at a situation where at least we have started the process of debating, and maybe it's time to start considering investing. But clearly, clearly it had gone through a period where we used to think that the sector was beyond our outlook and we would never look at it. Now that phase is gone. And we have now started to look at it after the negative news which has started to come. Everyone cribbing about margins and all that. Because you're not going to have a situation where we are not going to eat bread. We are not going to eat chocolates. We're going to eat all these things. We are going to have coffee. So, at the end of the day, this is a sector which is going to grow for the next 10 years, 20 years. The only debate with the sector was valuations and not the outlook of the sector.
Okay. Naren, is it time to now start coming out of perhaps energy, metals, the so-called typical value part of the market?
I don't know whether you call it value, but I would say certainly this is a time to actually think whether the reverse to do, whether we should do a systematic withdrawal plan from that part of the market. Because some of those sectors, when we as contrarian investors looked at some of these sectors, people used to say, what's wrong with you? Why are you looking at metals? And today, it's become the other end. So I think this is the time to consider a systematic withdrawal plan from the market. Because see, none of us, when we invested, we don't want wars. But the reality is the war has changed a lot of things. And if the war ends, clearly some of these prices that we see of some of these commodities are exceptionally high. So I think clearly this is a time to consider systematic withdrawal plans, particularly from some of the metal sectors. And how to do it is what we are debating at this point of time. So what we used to talk on this channel a few years back and what we are talking at this point of time is possibly exactly opposite. Because there were times like a few years back where we used to say the only sector to consider for investing is sectors like metals. And today what we're saying is something just quite the opposite at this point of time.
Spoke about two-wheelers. Where else are you finding this combination of low attractive valuations and lot of fear?
See, clearly, if you look at it, banking as a sector has been troubled by too much ownership rather than fundamentals. And I think over the next few years, some of those stocks have underperformed quite a lot. And I think there is clearly scope for systematic investing in an area like banking. Auto is a sector where, 3-4 months back, we were very positive. But the combination of possibly much higher interest rates, much higher petrol and diesel prices, and much higher metal prices has made our view look foolish at this point of time. But having said that, again, just like, you need to eat bread or chocolates and those kind of things and soaps and detergents, you can't live without auto over the next 10 years. So I think at some point of time, autos have to recover. Again, there is a case of systematic investment and systematic way of looking at the sector over the next 5 years. So I think these are all sectors which look interesting. The point is, what is that point of maximum pessimism? When do you actually take that big bet and say, this is the bottom? These are all very interesting in many of these sectors. But I would say some of these sectors have already started to look attractive. And how to invest in them is, I'm finding it very interesting because these are all not sectors which, we have been focused on many years back. We always used to be focused on things like oil, metal, telecom, and only those kind of sectors we used to be focused on. So it's an interesting change for us that I'm talking about sectors which I have not been focused on. And I would say my team is helping us because many of them have actually been focused on these sectors and they help us in trying to think what is that bottom, and till that point of time, maybe we will do systematic investing, and that is how we look at it.
Interesting, actually, and I must say on record, Naren, you're the first person who's come out and said that buy FMCG we've definitely got a headline from this interview. But that aside, Narendra,
I use the word, start looking at FMCG and investing.
yes.
That's the way. And even there was another headline which said that you have to buy aggressively. I never said that. But the headline came that way. So immediately 22 people called me and told me, I said, read the entire text, what I said. I said, next 18 months is the time to consider consumption stocks and FMCG. And that's what I had said. So people interpret what they want to interpret. Even now, I would say that the next 18 months is the time to accumulate it. And that's how I would look at it.
Don't worry, we got it right. Look at systematic route. Don't deploy all your money in one go, but gradually park your money into consumer as well as FMCG names. But Naren, that I understand that your style is contra. But what about the part of the market that is looking good? IT, for instance, it seems like because the correction in IT began with the Nasdaq correction, which transpired back in October last year. And it seems much of it has already played out, at least on a month-to-date basis. You've got the Nasdaq itself, which has jumped up about 11%. And IT stocks back home as well have sort of stood the test of time. And that, war, inflation, whatever have you, you need tech.
Yeah, it's a great sector. But, the fact is that, I rely on my colleagues who are much more growth-oriented. To actually help me in this sector at this point of time, because the trailing price to earnings they used to trade at, now they are actually much higher than that. So they have to help me in this area because I find it difficult when the trailing P's go up. So it's actually my team which has helped me. And some of them who are more growth oriented have actually held on to the stocks and benefited. Whereas what we did was we actually shifted some of the IT to Pharma, and Pharma has done well recently for us. So I would say what gain we didn't make in technology, we made in Pharma. And so I would say that's what we did. But I would say I'm dependent on many of my colleagues who have actually done a good job of looking at the sector at this point of time.
Naren, so let's understand the risk-reward ratio. We don't know what will happen on war. We don't know what will be the impact of inflation in terms of the central bank policy action. Now, typically when you see both the factors coming together, where interest rates they go higher and demand it starts coming down, we should brace ourselves for no return or negative returns. Is that the scenario for next 2 or 3 years, that the best of the equity gains is behind us? Next 1 or 2 years we may not get anything. I mean, I'm an optimistic. I always believe light at the end of the tunnel. But that is the reality which we can't close our eyes to. Markets are markets.
I look at some of the areas that we talked about in the show. I believe that an investment in a floating category is going to give you a very decent risk-return experience, in my opinion. Clearly, in there, whatever happens in the next 2 to 3 years, this was our organization's brief. The second clearly is if you follow asset allocation as a principle, the benefit that you're going to get out of all the volatility out of Fed, Ukraine, local interest rate hike at some point of time, that is also going to give you, the volatility itself will give you returns, in our opinion, over the next 2 to 3 years. So I think clearly investing in a theme which is not delivered, like housing or any other theme which is not delivered at all, can also deliver returns, in our opinion. So all these categories have more scope than what the market can over the next 3 years. Both floating rate, asset allocation, and any theme which is not delivered for years in the past, I would say. All these three have better scope than the market. So for us to be scared and say we are going to get negative returns, certainly I'm not going to say it for floating interest as a category. I'm scared to give return numbers for anything, and clearly the regulator is right in saying never give any return expectations. So I would not give any return expectation, but I would be comfortable with these three in the entire framework that we have at ICICI Prudential.
Naren, one interesting, not one, but I guess the mega trend is that foreigners are selling and domestic institutional investors are buying. When you speak to your distributors, when you look at the pattern of the flows, do you see that this kind of an commitment which is coming from Indian investors is here to stay. And the reason I'm asking you this, Naren, is because for the first time, perhaps the temperament of a investor is getting tested. I mean, someone who's come, let's say, after 2020, you pretty much enjoyed a honeymoon period before March happened.
I'm a believer in behavioral finance, but I must say the sales team at ICICI Prudential and some other mutual funds have done a very good job. And, so far, they have made SIP into a great product over the period. And if they continue to manage to, if at ICICI Prudential, my sales team continues to make SIP into a great product and continue to get that buy-in from so many investors, I think a lot of investors are going to benefit over the next 10 to 15 years. But let's see the global experience. The global experience says that even in sophisticated markets like US, we have seen all kinds of mess like a SPAC and the kind of loss-making companies which managed to do IPOs at stupid rates. Even in India, luckily, we were careful in some of the new age IPOs which came, but at that point of time, many of the sophisticated institutional investors also got sucked into one or two of those IPOs. So I believe in behavioral finance, and it is easy to get caught in greed. So I'm hoping that the SIP investors in India stay committed to the next 10 years in SIP. Then they're going to have a great experience. And so far, my sales team at ICICI Prudential have done a great job. And I hope they continue to do a great job in popularizing SIP in bear markets. The importance is that in bear markets, if people don't swear on SIPs, it's a real problem. And that is very necessary for the sales team to continue to get the investors to swear by SIP in bear markets. And that's what I'm hoping they will continue to do.
And what is your understanding on the kind of shift which is happening within balanced portfolios? A lot of our understanding is that apart from SIP money which is coming to markets, there is also a reallocation by balance schemes where they are reducing exposure to debt, increasing to equities. That is also one of the reasons why money is coming from the DI front. Is that true, and do you think it's here to stay?
I think clearly, I think in the mutual fund industry, we were the people who pioneered the balanced advantage fund category, and now everyone has got into it. And I think that category and the asset allocator fund of fund kind of category in the fund of fund space are very good categories for any 10-year investor or any 5 to 7-year investor. So I think that category becoming bigger is also going to benefit a lot of investors in the long run. And I believe that even categories that the fund we launched in December, like the ICICI Prudential Passive Multi-Asset Fund of Fund, is the kind of category, again, if investors choose to invest in, is the kind of fund which investors will benefit if they are invested for five years and above. So I think it's been a very good experience thanks to the regulator and the good work done by the mutual fund, that we have got now many interesting products which if investors stay invested for 5 years or keep investing during bad times, the experience can be superior. And that is the good thing in this entire period, that we have been a mutual fund, and I spent time in ICICI Mutual Fund. It has happened, and that's one of the things which keeps us going every day and continuing to learn from our investors and our customers and what we do daily in our investing career.
Naren, always great having you on the show. Thank you so much for joining in.
Thank you. Thank you very much.